Hello everyone. I hope all of you are doing well. Well, the purpose of making this video is all about that we have to discuss. We will be solving the practice exam, the past paper, specifically, which has been launched for September-December 2025. The recent past paper of FR exam. We will be discussing the whole past paper one by one. I will be solving the first question, then I will be recording another video for the second question as well. So please be focused. Well, first of all, you have to assign, and we will be solving those questions on the practice platform. ACCA practice platform. So listen very carefully. Uh, First of all, we have to log in the practice platform. Then we have to access, we have to assign the specific paper. Okay, if you can just browse the available exams and focus is FR. So just go to the FR, financial reporting, and then assign a paper, the recent one, this September, December, specifically 2025. Just assign yourself and it has been assigned. Just come back to the main screen, view assignments, click on this financial reporting. So before you start, make sure that you save the offline. It will help you. Let's say if you are having an internet issue, it will run if you have saved the offline. So let's start. Now we are ready to start. Okay, as screen is loading, there will be definitely a certain guidelines. I'm just skipping these guidelines. And if you are a student, first time appearing for any skill level paper, make sure that you read these requirements before going to the, let's say, main exam. Okay. And make sure that you scroll the whole screen, because if you are not going to scroll the complete screen, it will not go to the next screen. See, you will face the challenges. You will see this again and again if you are not going to scroll the complete screen. So first scroll the complete screen. And now we are ready to start. So the first question is about ratio analysis. Let's just skip this. I will be recording this in the second video. We'll be solving another question, the second question of this past paper. This is the second question. Well, what this second question is about: calculate the goodwill arising on the acquisition of Strawberry Company, 1st July X5. 1st July X5, we have acquired a company, Strawberry, and that company we acquired on the 1st July, and we have to calculate for 5 marks, we have to calculate the goodwill. And for this group is a basically partridge group, and partridge group, for the partridge group we have to also prepare the consolidated profit and loss. It's just profit and loss, it's not an other comprehensive income, it's just consolidated profit and loss, and for the year ended 31st March X6. Please remember always when you are reading the question, make sure that you make the timeline. If your year is ending at 31st March, it means it has been started at 1st April X5. And you have acquired the company at 1st July X5. So from this requirements, it is getting clear that we have not acquired the subsidiary for the whole of the year. It's an part acquisition. It's in part acquisition, and this acquisition is actually from July to March. So most probably it will be 9 months. It's a 9 months acquisition. So when you are preparing consolidated profit and loss, make sure that you time apportion the results of subsidiary, not the parent. The main company result should be for the whole of the year, but your subsidiary should be for 9 by 12. 24,000 into 9 by 12, 14,000 into 9 by 12. So you'll be doing this all, let's say, from the top to down, let's say. Okay, so first requirement is goodwill. Let's just give the heading. Now remember, you will see the same size of Excel in the real paper as well. And you can, let's say, increase or decrease the size of screen using this specific arrow. If you want to, let's say, expand the Excel, you can expand the Excel. If you want to show the, let's say, question first, it's up to you. You can manage this screen, but again, try these things before going to the actual paper. Make sure that you practice these things during your practice sessions, right? Okay, so first of all, requirement A, A is about goodwill arising on. So just Control C. If you are very good at it, if you are not good at all, you can simply just write, let's say, this way as well. It's up to you. I mean, it's up to you. Goodwill arising on the acquisition, right? So this is my part A, right? I'll be calculating first goodwill for 5 marks. Then there are, let's say, leave the around 8 to 10 rows, let's say 3, 4 columns, and just give the B heading. B is all about the Patridge Group profit and loss. You can just write down here, right? See. So it's B and it's the A one. Now, if it's up to you, it's not mandatory. You can just write down A and B. It's not mandatory that you should write Goodwill or a Patridge Group consolidated. It just look more professional. Okay, if I see the question, if I see the data, let's just make it like that. The Patridge Group consists of Patridge Co. and it is single subsidiary Strawberry Company. Say Strawberry Company. Now their results are there. The introductory line is this: they have only one subsidiary, right? Okay. So its revenue is there, cost of sale is there, operating expenses are there, general and administrative expenses, selling. I will quickly say that make a pro forma. It will make easy for you. Just make a quick pro forma. $30, comma. What's the pro forma? A revenue. That's what cost of sales. You will be having a gross profit. Then you can write general. It's up to you. You can copy the same pro forma operating expenses, general and administrative expenses. If you're very good at, let's say, copy paste, you can copy paste these things as well. See, selling expense. I'll be writing here selling expenses. So it's up to you. Again, the process which, let's say, suitable to you, you can follow that. Operating profit, then we will be having our investment income, right? If you are good at typing, then type. If you are good at Control C and Control P, you can do that as well. Sometime in paper, Control C, Control V doesn't work always. Profit before financing and income tax, right? And interest expense, profit before income taxes, and the income tax expense less the profits for the year. And always remember you have to attribute as well. This profit attributable to the patronage, mean the parent, and this profit is also attributable to NCI as well. I have no idea whether NCI is there or not, but I'm just writing total profit for the year. So this will make things easy for you now, as you have already made the pro forma. Now this will work easy for you. Now you can easily, let's say, see, I just done the Control X and Control V in order to shift the $30 over there, right? So I think now we need to read the question in order to understand what are the main things over there. 15 marks for the profit and loss and 5 marks for the goodwill. And you can just use the $30 using this function as well, right? Okay. So on the July expire, by the way, there are 6 notes available. And one of the note is very common. The profits accrue evenly over the year. That mean that these profits are equally going to be divided by over year. The profits they have earned equal profit over the year. If the profits they have earned different before acquisition or after acquisition, then this specific note will not be the same. Then they have mentioned that they might have earned 40% profit before or 60% after. Let's just ignore this. Profits are accruing evenly over the year. Okay. So now we are only left with the 5 notes. The first note is about on 1st July X5, Patridge Co. acquired 80% of 1 million ordinary shares. Okay, they have a 1 million ordinary shares. $0 is common, right? They have a 1 million ordinary shares. And Out of 1 million, they have purchased 80%. Okay, what are the purchase consideration? 19 million cash payable immediately. So one mark is very easy. Cost of investment, in which you can write cash, which is 19 million, right? 19 million. $30 is common, which is payable immediately. But the 2.54 is payable on 30th June X7. Please listen very carefully. It's called, and there is no condition attached with this amount. It's not an contingent consideration. It's a deferred consideration. And it's not for the 1 year. It's a July X5 and you'll be paying in June X7. So it means 30th June X6, 30th June you'll be paying 2.4 million after 2 years. Make sure that you are getting the present value using the formula in a right manner, right? It's called the deferred consideration, and deferred consideration is always recorded at the present value of future cash flow. So future cash flow is 2.4 million, which is 2400, right? Into what is the discount rate? Although they have already given the discount factor as well. They have already given the discount factor. You can directly multiply by the discount factor, right? 0.826. Okay, so it's 1982.4, right? So you got the answer this correctly. It's 1982.4. And what about its cash deferred consideration is there, right? Now remember, when you are going to unwind this, make sure that you are using the 10% rate. And remember, the finance cost will be 9 by 12 because it is not a complete year acquisition. It's a part way acquisition. So the finance cost will be 9 by 12. Remember this point when you are going to write the, let's say, interest expense. I have no idea whether there are other interest expense might be there, but what is P plus S? This 2000 plus with this 1000 into 9 by 12 plus this 1982.4 multiply by 10% into 9 by 12. We'll be doing the working of this as well later. Second, now you have to write the fair value of NCI. Why? Because you have only purchased 80%. So there's a NCI as well. Fair value of NCI as well. Now, where is the fair value of NCI? If you can go to the, let's say, note 3, Partridge Co measure NCI at fair value. Okay, NCI and fair value is not given. Fair value is not given. We have to calculate. When as a parent, there are two options. You can value the NCI using net proportion method, and the second method is fair value, right? So what's the fair value method? Number of share held by NCI multiply by the share price of subsidiary. Number of shares held by NCI, the subsidiary having a 1 million shares and 80% you have acquired. So it means that the subsidiary is having only 20%, 1 million multiplied by 20%, which will be 200 shares they are having. And the share price of subsidiary is 13. The share price of subsidiary is 13. So multiply this with the 13, right? So see, this is what the fair value of NCI. Now we got the fair value of NCI as well. Now, in order to calculate the goodwill at acquisition, we need the net assets of subsidiary, which is here Strawberry Co. Net assets of Strawberry Co. at acquisition. You can write full as well. It's up to you. You can write full as well in order to just show, let's say, this is the, sorry for the spelling. Okay. So now what are their net asset at acquisition? What are their net asset at acquisition? We'll get the details from this specific note regarding their net assets. Okay. If I can quickly go here and do the working one, net assets of Strawberry Co. at acquisition. Remember, those are at acquisition. Okay. Now, see how I'm using effectively the Excel, the presentation. Okay. The July net assets has a carrying amount of 15 million. Already they are having a net assets, which is already given the value. Total value is 15 million, but there are certain exceptions. What are their exceptions? Although the fair value of net asset were same, plant and inventory, they have a certain exception. Plant had a carrying amount of 4.1 million, but fair value of 4.9 million. So it's an plant fair value increase. 4,900 minus the 4,100. So it's an basically increase of 800. It is an increase of 800. Well, we will be charging depreciation in profit and loss because here we are not supposed to make the complete working of net asset at acquisition and reporting separately, because we only need the net asset at acquisition because we are not making complete SOFP consolidated. We are just need a calculations of goodwill, and for the calculation of goodwill we need net asset at acquisition only. So see working one net asset, I'm just making this more specific so you get more clarity. Now net asset at acquisition. Okay. Depreciation is going to be part of cost of sale. And remember, this 8 million and life is 4 year. So this 800 divided by 4 into 9 by 12. Again, you will be time apportioning the depreciation expense as well. Okay. Inventory had a carrying amount of 2 million, but fair value is 2.1. Okay. Inventory is a current asset. Their inventory has also increased. This is something which is new, and sometime FR examiner does include these type of exceptions as well. This is something which is rarely tested, but it is very important. When the inventory is also increased, we have to incorporate that fair value as well. So it's basically 2.1 minus 2000. And all these inventory were sold. This line is very, very important. I will be explaining you later. See, at acquisition, this inventory value has been increased by 100. We have incorporated that 100, right? But at reporting, this inventory is completely sold. So it means there is no closing inventory. At reporting, there will be no adjustment regarding the inventory. Okay, I guess this is all about their net assets. This is all about their net asset. Let's just total is equal to sum. Make sure you are applying the correct formula. So now equal and minus sign, link this. You have got the 5 marks. Goodwill at acquisition. You got the 5 marks. Goodwill at acquisition. Just sum properly. See the working, the answer is not difficult. It's just that you need to follow a right pattern. You need to follow a right pattern. Even if you are making any small mistake, right? Let's say you are not getting the correct valuation regarding, you do not have idea what is the correct treatment of inventory. Let's just ignore it. You will get the remaining marks, right? It's not about the perfection. It's all about time management, right? Do not challenge yourself that let's say I'm supposed to make it in 100% correct. No, sometimes it's about the time, sometimes it's about the situation, right? So this is all about the part 1. Now let's discuss about the part 2 so we can continue. Okay, so part 2 is all about profit and loss. This is one of my favorite and one of easy area as well. So let's see what are the areas are there. I always tell the students that revenue area is very easy. Make sure that you quickly fill the revenue. Okay, now listen very carefully. We have done with all the numbers. Now, between 1st July to 31st March, they have already written the post-acquisition period from 1st July to 31st March. P company, its parent, it's not subsidiary, P2S, parent has sold goods to Strawberry 3 million, which had a markup of 25% on cost. Let's just Ignore that markup. What is the intercompany sales that are 3 million, and it's already during the post acquisition period, so you will get the easy marks for revenue. 35,000 plus this 24,000 into 9 by 12. This is very crucial. Make sure that you were doing this 9 by 12. I have seen lot of students often after completing their exams that do forget that they have not time apportioned. So it's something which is very important. As you have already seen that this timeline at the start, I have already decided how I will be working on this specific area. Minus the intercompany sales, these are the 3 million. Minus this 3 million. Okay, see, this is the marks of revenue. You have already got the marks of revenue. Now think about, let's say we got the marks of revenue. Now we will be covering, let's say I will be doing working of cost of sales. I often tell students that do the working of cost of sales, because sometimes cost of sales include lot of other things as well. So it's really get difficult to do all the working in one cell. So make it easy for yourself. Do a separate working for cost of sales. Okay. What is the working? Let's say just give the $30. What is the costs of sales of the parent? Parent company cost of sales are, let's say, and strawberry company cost of sales, right? Parent company cost of sales is 21,000, right? And the other company is having a 14,000, but we should be doing time apportion into 9 by 12, right? This is 14,000 into 9 by 12. Then we will be deducting the intercompany sales, which we have already discussed down there in the note that it was 3 million. Now, is there any perp or not? It is P2S. Remember, it will not affect the profit attributable to NCI, because it is not going to affect the subsidiary profits. We will be removing the unrealized profit from parent profits because it is a parent to subsidiary sale. So see here, on 31st March, the inventory of Strawberry Co included 900 of these goods. 900 of these goods are still in the inventory. It means there is a certain form of perp as well. We will be calculating the perp as well in order to get the proper answer regarding what will be the answer of perp as well. So listen very carefully. Now, what level of inventory they have left? It is a 900,000, right? So we'll be doing 900, right? They have already given us the remaining inventory. Normally, we have to apply a certain percentage. They sometimes say that 30% inventory left, 40%, 1/4, but they have already given the remaining inventory, the unsold inventory. Right, on that unsold inventory, profit earned by a parent is a unrealized because it is not being sold to the third party. It is between the group. It is basically between the group, right? So see, 900, and it is a markup. In markup selling, your cost of sales is always 100%, right? So it is basically 125%. How we'll be calculating the perp into 25 divided by 125. You will be getting a calculations of perp as well into 25 divided by, let's say, 125. So it is a 180. It is a 180. Please understand this is very important. It's a 180 unrealized profits, right? It's perp. So perp is basically we are removing that profit. So we have to add in the cost of sales. Okay. Now, after doing that, there were two items. One was depreciation. The fair value of plant has increased. Remember, the fair value of plant has increased. So we have to include the depreciation as well. Depreciation of on the plant. Now, what was the depreciation? How we are going to calculate? What was the increase in fair value? It was, I guess, 4.9 minus 4.1. This is the calculation, 800, right? Divided by, what was the life? It was 4 years into 9 by 12. So 150 depreciation. And also inventory fair values increase at the acquisition. So if your inventory fair values increase at the acquisition, what was the formula of cost of sale? Opening inventory plus purchases minus closing inventory, right? So at opening, at initial, your inventory has been increased by 100. So it will lead to increase of cost of sales. So it will increase inventory fair value at acquisition. It will increase the cost of sale by 100. If they have not sold the complete inventory, as they have already sold the complete inventory, see this line, as they have sold the complete inventory, the all inventory, it means there is no closing inventory. If there is any closing inventory, I have to also write down the closing inventory in cost of sales as well. Closing inventory is going to be recorded at the net asset at reporting as well, right? And that closing inventory is going to reduce the cost of sales. Right now, there is no closing inventory. They have sold the complete inventory. That's why it's just the opening inventory is actually impacting the cost of sale. Right now, they do not have any closing inventory. That's why their cost of sale is only going to be affected by the fair value at acquisition. Okay, these all are the part of this. So let's just sum. So it is a cost of sale. I will be giving a link. See, this is cost of sale is equal to minus. This is a cost of sale. Sum, right? See, this is gross profit. Normally, it's the gross profit. Now, in the case of operating expenses, there is it's a dividend there. We'll be talking about dividend later. There is no impairment. There is no any admin expense. It means these are the free marks. You have to just time apportion both of these. These are the free marks. These are going to be most probably 2 marks. They are free. Why it is free? Because you have to just do minus, right, is equal to minus 4,000 plus 2,800 into 9 by 12 plus 2,800 into 9 by 12 is equal to minus this 2,000 plus 1,200 into 9 by 12. Right? Now, let's talk about these are called operating profit, by the way. Sorry, these are called operating profits. So we got the answer of operating profits as well. Right? Okay. Before moving to forward, let's say to investment income and the finance cost, I will be doing the calculation of income tax, which is again a free marks. 2,450 plus 1,000 into 6 by 12. 2,450 plus 1,000 into 6 by 9 by 12, sorry, 9 by 12. Now let's talk about interest expense. This 2,000, I'll be doing working for you, although, okay, I will be doing another working for you. So make it very easy. Although you can do the calculation in the cell as well in order to save your time. How is equal to minus bracket this interest 2,000 plus 1,000 into 9 by 12 plus the unwinding of the deferred consideration. Unwinding of deferred consideration. This is the present value into the 9 by 12. This is the easy way. 2,000 plus 1,000 into this is the 1,000, right? This is the finance cost plus the unwinding. So I have done, I hope, yes, it has calculated the correct calculations, right? Now let's talk about the investment income. Okay, before moving forward to investment income, we have to see, we have to look at the note number 5. Read the note 5. This is very important. Read the note 5 so we understand what is the in note 5 as well. Okay. See the note 5. One of the quick calculations we have to correct. It's just that this one, that we have not applied the rate. Mean this unwinding, the present value of deferred consideration multiply by the discount rate, because we have to calculate the unwinding. This multiply by 10%, right, into the 9 by 12. So see, this is the right calculation. I mean, you can do like this as well. We have to actually add the unwinding, right? So what is the unwinding? What is the that is actually called the interest cost as well. So the present value of deferred consideration, right? The present value of deferred consideration multiply by the discount rate, which is 10%, into the time apportionment into the post acquisition period, which is 9 by 12. If it is a full year acquisition, I was not required to do the time apportionment and all that. So see, this is the correct calculation regarding interest expense. Now let's talk about the investment income. Regarding the investment income, what is the correct treatment? They have paid us a dividend of 2 million as well, right? Now listen very carefully. They have paid us a dividend of 2 million as well. We have to deduct that dividend as well. We have to deduct that dividend as well. Remember, it's very, very important that let's do the calculation. P plus S. What is our investment income? 4,200 plus the 4,200 into 9 by 12 minus the intercompany dividend. This is very, very important, because the dividend you have received from subsidiary, you have already included that in your investment income, right? They have paid a total dividend. They have paid a total dividend of 2 million. And what was your percentage? How much you have acquired? You have acquired the 80%. So it means out of that 2 million, the 80% portion has been received to you as well. The subsidiary has paid a dividend of 2 million, and out of that 2 million, we have received the 80% portion as well. That we have recorded in our individual account in an investment income. When you are consolidating, you have to remove the intercompany dividend as well, because now we are already adding line by line all the expense and incomes of the subsidiary as well. In the individual accounts, we have received the dividend, and parent has already included the dividend received in this income. We have to remove minus intercompany dividend. How you will be doing minus bracket? What was the dividend they have total paid? 2 million. And out of that 2 million, we have received the 80%, because we own the percentage 80%. So it's 2750. Now we have done the all calculations. So we can sum the remaining figures, right? So it is a profit for the year. It is a profit for the year. Right? Now we will be attributing these profits between parent and NCI. Just give the link. This is the total profit. Now do the working regarding profit attributable to NCI. Profit attributable to NCI, working to profit attributable to NCI. It's up to you. You can choose any method, but what method I'm choosing, normally I always tell my students that you need to do a proper working. What will be the working? Start, because profit attributable to NCI. NCI will be getting profit share from the subsidiary profits. From the subsidiary profits, right? So first of all, write down the subsidiary profits, Strawberry Co profits. And make sure that you time apportionment those profits, because this is not a full year acquisition. We have recognized the NCI from 1st July onward. So they have a complete profits, whole year profits are 4,200, but 4,200 into 9 by 12, right? This is going to be 3,1. Now we have to make certain adjustment. Why? Because due to the consolidation process, we have recorded certain additional expenses like the depreciation, which has led to reduction in the profits of subsidiary. So you will be deducting the depreciation on plant. You have to make all the adjustment which has impacted the subsidiary profit. Whether it is an addition, you can add. Whether it has reduced, you have to deduct. So see, because of the increase of the plant fair value, we have to record, we recorded the depreciation on plant of 150. So which is actually going to reduce the profit share. Just give the link, right? Perp is not going to be part here because it was not S2P. The sale was from parent to subsidiary. So it has impacted the parent profits, not subsidiary, right? And this inventory fair value, yes, this has also increased the cost of sales, right? So increase in cost of sales has led to reduction in profits because the expense has increased and profits are eventually reduced. So now these are going to be called adjusted profits, right? These are going to be called adjusted profits. Sum and give the share to NCI. What was the percentage of NCI? Which was 20%. So 2,900 into 20%. 580 is going to be NCI. What was the complete profit for the whole group? It was 8721. So just use the formula, this 8721 minus the 580. Remaining share is going to be part of, let's say, the main company. So see, this is how you're supposed to do the all of your workings. Profit attributable to NCI, and this is the total profit for the year. So, and how you're supposed to use the effective, how you can use the ACCA practice platform in an effective manner. I have mentioned you can give, let's say, headings, control B, control U, working one, working two, and you can link them. See, I have given all the links. It's not just only doing the calculations, giving the link 1509. Same goes with this, those small calculations, even this 580 as well. This is all about call link. Even if, see, it's all about the practice. So this is the question one. I will be solving the another question as well. I'll be recording the ratio question as well. So make sure that you should watch this properly in order to learn how the, let's say, this whole process work. So thank you so much.